So this is the video lesson for the practice problem 1. So you were asked to prepare the vertical analysis and horizontal analysis for Small Lira Golf Corporation. So we have here the amounts and the accounts under the balance sheet section, and also we have here the income statement accounts. So the first part is the vertical analysis, and then we have the second part, which is the horizontal analysis. So I'm going to explain some of the ratios here, and we'll try to interpret the corresponding ratios that we have computed and try to provide some implications for these ratios. Okay, first we have the vertical analysis. As we have explained in our last virtual class, so the vertical analysis focuses on a specific year, and we restate the financial statements in a standardized form and use the assets as the base for our balance sheet. Meanwhile, for our income statement, we use the sales as our base. So when we say it's our base, meaning the assets will be our denominator, and for the income statement, our sales would be our denominator. So how do we get the vertical analysis? So each of the accounts here will be divided by our base, which is total assets. So therefore, to get this one, so here is our formula. That would be B7, which is this amount, divided by total assets. So we will get 2.69%, and you have to do the same for the rest. So 2,106 divided by 26,382, and so on. The same goes with this one. 1,215 divided by 26,382, and you will get 4.61, and so on. Okay, so for the income statement, we will follow the same procedure. However, our sales will be our 100% or our base. So therefore, to get this ratio, we need to divide 11,600 by 28,000, and you will get 41,000.43%. For depreciation, you have 2,140 divided by 28,000, you will get 7.64. Okay, so after we have computed these ratios, we can now start to investigate the amounts, the ratios here. And if we have the complete information about the company, then we can find out the causes of these ratios. And that is why we need to prepare these types of analysis, because it will help us easily identify some differences and unusual changes in terms of the ratios that will be computed. So for example, in this case, you can see that our cash here is 2.69% of the total assets. So we can say here that it has lesser available funds in order to pay for any possible expenses or pay for its liabilities that are due within 1 year. So for example, if our creditors will demand payment for these items, such as accounts payable, notes payable, and other types of payable, if all of these creditors will require us to pay them, then we don't have enough money because we only have 710 pesos. So by this given ratio, we can say that it has low availability of cash. And even though we have this accounts receivable, we can use this one to pay for our debts, but we cannot really guarantee that all of these accounts receivable will be collected in time before these creditors will demand for the payment. But if you're going to get the current ratio for this one, which is current assets over current liabilities, we can get a clearer picture of the liquidity of the company. So how do we get the current ratio that is equivalent to your current assets divided by your current liabilities? Okay, so if we go to the financial ratio analysis, you will learn that there are several other ratios that can be used to test if the company is liquid. But if basing on the cash alone, the capacity of the company to pay if this liabilities will become due, so we only have 710 pesos to pay, and we need to speed up our collection so we will be able to pay for our immediate debts. We can also see here that our net plant and equipment covers most of our total assets, which is 70.44% of the total assets. So we can say that the company heavily invests in plant and equipment. And since we don't have any background what type of products or what type of services that Smolira Gulf Corporation provides, so we can say that they are more on focusing on purchases of fixed assets compared to inventories, since we cannot see any uh, greater bulk of inventory in here. Okay, then in terms of their debts, their liabilities, they don't have much debt. If you will sum it up, the total percentage of our liabilities would be, okay, let's sum up the ratios. Okay, so the total liability ratio would be 24.08%, while our total equity is that is 70+%. So this means that they are not relying more on the debt in financing for their assets, but they heavily rely on they're more focused on the equity. And you can see here that the retained earnings and the common stock are nearly the same amounts. So they do not use more of the borrowings in order to finance for their assets. But we can see if this is really true if we perform the horizontal analysis and we get the comparison between last year and the current year. So now let's go to the income statement. So we can see here that out of the total sales, we have 41.43% of it will be consumed by the cost of goods sold, and we have 7.64% goes to depreciation, and then we deduct the interest, that would be 3.50%, and the taxes, we cannot avoid this one, so that comprises 16.60% of the total sales, which gives us 30.83% of net income over our total sales. So if you can try to observe in this one that a large portion of our costs and expenses is attributed to our cost of goods sold. Okay, remember that this would be the first deductions that would be made against our sales. And if this cost of goods sold in itself is too large, so we can expect that the remaining profits would be lesser. So as much as possible, we have to make sure that we can reduce our costs, but of course we will not sacrifice the quality of our products. So what are the areas of concern in terms of our cost of goods sold? So the cost of goods sold includes the direct materials, the items or the materials that are used to make the products. We have the direct labor, which is the uh, wages of the workers who creates the product, and the third one is the overhead. So these are the other costs and expenses necessary to create the product. So these are three: direct materials, direct labor, and overhead largely comprises this cost of goods sold, and we need to reduce this cost so that we can get a larger gross profit, because from the gross profit we will still deduct the operating expenses, the finance costs, and also the taxes. Okay, so as you can see here, the company has a large net income in terms of percentage. This is acceptable rate um, if we would try to um, compare that with our existing sales. This is already acceptable, but if we want to improve on our net income and we would want it to be more in the next period, then we can focus our um, measures with the improvement measures with our cost of goods sold, because primarily this can be adjusted and this can be improved. For our depreciation, this is really based entirely on our fixed assets. So if we have fixed assets, we cannot avoid depreciation. And interest paid is based on our existing liability. So as long as we have our liabilities, interest will stay. And if we will borrow more, then we will expect this one to increase. And of course, our taxes is based on our taxable income. So if we have large or huge taxable income, we will expect that this would also be in greater amounts. Okay. And now let's see the horizontal analysis. So if we compare last year to the current year, this is the percentage change. If we will try to compare this solution in the first example I have provided, wherein you can see 100%. If you can recall CS company, so we got the percentage by dividing the current year, which is 20xy, and we divide that with the past year, that is 20xx. So you will get 1.09.231. So we multiply this with 100 to get the 100%. Okay, so this is 109.23%. Okay, so this means that from the previous year to the current year, there is a 9.23% increase. Okay, so it's just the same with 109.23, and you deduct that from 100. I'm referring to the example I have provided for CS company, and you would do the same with the other items. Okay, so this would be in, again, this is in percent. Okay, and this one is the percentage change. Okay, so this means this is 100, which is our base year, and then we deduct 100 from 109.23, and you will get 9.23. And then we deduct 100 from 88.41, then you will also get negative 11.59, and so on. Okay, so you will get 23.09 or 23.10%. The same goes with here. So don't be confused with the first example and this example. So in this column, we're getting the percentage change. Okay, it's just the same when you deduct 109 and 100% for the base year, you will still get 9.23. That's why we get a percentage change, because we would like to see if it's improving or it's deteriorating. So for the balance sheet, we can see here that it has improved by 9.23%. It's good. It's better than having negative percentage. Okay. And then for accounts receivable, you have negative 11.59%. Inventory, you have 13.02%. Then so on. So what can we say about the balance sheet of Smolera Golf Corporation? We can see here that our accounts receivable decreased. And what could be the implication for the decrease? So there may be several reasons, and we cannot pinpoint exactly what is the reason, since our information is just limited to the amounts here. But we can say that it decreased from 20xx and to 20xy. And is this a good news or a bad news? Well, it depends. There may be some reasons why there's a decrease. One reason for the decrease could be they were able to collect the receivables, and it could be attributed to the increase in our cash. That could be one. Or we can say that customers preferred paying in cash rather than on account. But we should also see a significant increase in our cash if there is really a preference on cash payments rather than on account. Or third, we can say that we have lesser sales because perhaps some customers don't like to buy from our company anymore, that they don't choose on account or for cash in terms of their purchases. That could be one. Or we have written off some of our accounts receivable because they are really doubtful of collection. It could be. Or we have increased our allowance for bad debts. That's why our net accounts receivable decreased. So there can be many reasons. So we cannot just directly tell that the company has not improved, or we cannot directly tell that the company has improved, because we need to investigate why these really decreased. Okay, so we need other information, but that would be our initial theories why this will result in a decrease, but that is not conclusive. That's why we prepare this analysis, so we can identify what are some significant changes, and from there we can start investigating. Then for our inventory, we can see that it has increased by 13.02%. Is this good or is this bad? If we want to get the current ratio for the company, this will contribute to a greater current assets. But we have to take note that inventory is not as liquid as cash and accounts receivable. In accounts receivable, we only need to collect it so that it will convert to cash, but for inventories, we still need to sell it, and if we sell it on account, we still need to collect it. So it takes more time before this becomes cash. That's why it's not really we can say it does not really uh, provides us a much information of how liquid a company is if we are using inventory. That's why we also have another ratio, which is called as the quick ratio. It excludes the inventory because it's not as liquid as the other current assets such as cash, accounts receivable, and marketable securities. So, what may be the implications for the increase? It could be uh, they were not able to sell more on this year. That's why we have a larger stocks left, or we can say they're preparing for more sales next year. That's why they bought more inventories within the year. That's why it ended up with a increase in inventory end. Okay, so those are some of the possible reasons for the increase. But just looking at the figures there, so from there you will need to investigate why there is this increase. Is this just tolerable? Is this just acceptable? So we need to investigate that, and we can find that in our analysis. And here in our property, plant, and equipment, we have an increase by 32.82%. So they added more property, plant, and equipment. Okay, so if you look at the vertical analysis, sorry. Okay, so we can see that a big chunk of your assets is composed of the plant and equipment, and it's not surprising because for this year they added more. Okay, why are they aggressive in adding more? Perhaps their sales shoot up, that's why they're more confident in buying more fixed asset, or their services really increased, or their sales really increased. That's why they are confident in buying more of the fixed asset. Okay, in total, the total assets increased by 23.10%. For your accounts payable, our accounts payable also increased by 23.10%. This could be coming from the additional purchases such as inventory or the plant and equipment. And also our notes payable also increased. Others also increased by 155.56%, since the details are not given here. So you need to investigate where and why these increased. Meanwhile, our long-term debt decreased. It could mean that they have paid some of their long-term debts, and also they did not borrow on long-term. They did not borrow again on a long-term basis. For the common stock and paid in surplus, they did not sell for this year. Okay, there was no increase, or perhaps they sold common stock but then they acquired it back. That's why there's no change, but there's no change as of the end of the year. For retained earnings, we can see that it has increased immensely at 85.83%. So we can say here that their investments, perhaps in inventory, in net plant and equipment, was worth it, because you can see their retained earnings increased. And what does it mean if the retained earnings increased? It means that their net income also increased, because all net income goes to our retained earnings. And by looking at the figures here, we see that their performance was, we can say it's great, because it was able to increase their retained earnings. So they did well in terms of their performance. Okay, for the horizontal analysis of the income statement, we cannot prepare that because we only have 1 year data. So therefore, we can only compute for the horizontal analysis on our balance sheet. Okay, so that is how we can prepare the vertical and horizontal analysis. So it doesn't stop there by just computing. We need to analyze the amounts and draw some implications why these amounts, why these ratios were derived. And of course, it doesn't end there. We need to investigate the costs. That's why we have to go investigating the composition of this 9.23. Why is there a decrease in the accounts receivable? Why is there an increase here in our other payables? What caused this increase in our retained earnings? If this is attributed to an increase in our net income, then that is a good news. And so we have to improve our operations so we can increase further our net income so that our retained earnings will also increase. What happens if we increase our retained earnings? This will make, of course, our investors happy because they can see that there is something that they get, or there is a payoff with the investments that they have made in the company. Okay, so that would be all for this lesson. I hope you have learned from these horizontal and vertical analysis, and you can apply this in your homework for this week. Okay, so see you in our virtual class.